was the greatest warrior in the Greek mythology. His wins and accolades were far beyond words. He was invulnerable, yet he had one single weakness, his heel, which caused his demise. What if I tell you this story is even true today? What if rather than a death by arrow, it's death by debt?
Welcome back to Finance with MBA Grads. I'm your anchor, Amulya. Today we'll dive into a tale of LTCM, which caused losses for billions of financial institutions and high net worth individuals. What is LTCM? What happened actually? Let's see. Long-term capital management is a large fund led by a renowned Wall Street trader, John Meriwether, who also worked as an investor in Salomon Brothers bond trading. LTCM gathered the brightest minds of finance and economics to manage their hedge funds. May Shores of the Black-Scholes model was also part of the management team. May Shores came up with a model through various algorithms and mathematical formulas which was based on the past data trying to predict the market changes in the future. They made the hedge funds which was largest in the world and with the profit returns of 21%, 43% and 41% for the years 1994, 95, 96 respectively, which grabbed the most investors, companies and banks' eyes.
So, everything went well, right? But what did go wrong? Let's see.
To talk about the reasons why LTCM failed, first one is its own business idea of convergence trade, which made use of arbitrage strategy. So what they did was they started buying these securities in the markets where the prices were going low and selling it in the markets where the prices were going high, thus making profit from such transactions. However, and this did really work well and it was able to bring huge profits to the investors and they were able to make a $1 billion in capital investment. However, this strategy worked only when there was misprice between the markets. They did not know how to tackle in the situation where the prices in both the markets were falling.
The second and important reason why LTCM failed was model risk. Model risk is the risk of loss which is arising when the model is not properly tested and it is inaccurate. In the same way, this was happened with LTCM as well. Till 1997, LTCM was performing very well, but during 1998, when the Russian government failed to repay its debts, there was a huge impact on LTCM because they had a huge investment in this Russian bonds. They had made a loss of 100 million every day and it had amounted to 4 billion by end of 3 months. This was not only the reason but also this model works only when the market is rational and also it takes the historical data based on it would predict the future. Apart from this, LTCM also had a lot of debt. For every dollar of equity, they had $25 of debt initially, which LTCM had increased it to for every $1, they had $250 of debt, due to which they could not liquidate the position at loss. Hence, they ended up being at the loss.
So I will be talking about another factor that led to LTCM failure, VAR, which is value at risk. It is the maximum amount of risk that the company is ready to take. LTCM did not analyze this war model properly, due to which they were not able to identify what is the maximum loss they are gonna bear. Because of their inefficiency of analyzing the losses, they had a loss of about 4 billion and hence they were in a lot of debt.
The other reason being the lack of knowledge. So they started initially they invested in equities and debts and later they started investing in the other instruments in which they had no prior expertise and knowledge in. And also their auditing. So the other hedging funds did their auditing once in every 3 months, but they did their auditing once in a year.
So, what was the aftermath of this whole situation? A bailout was organized by the Federal Reserve Bank of New York for $3.65 billion, which was paid in whole by GS, JP Morgan, Barclays and other financial institutions. In return, what did they get? They got 90% of the controlling stake of the overall fund, while the remaining 10% was given back to LTCM. The total losses were $4.6 billion. After the bailout, the operations of LTCM still continued, yet the whole fund was dissolved by early 2000. So what are the lessons that we learned from this whole situation? Market dynamics matter. The market keeps on changing again and again, and if it is not considered, then any metric or any model fails. Liquidity matters. A company which has only $1 of capital for every $25 of debt is doing something wrong. It is highly leveraged, and that poses a huge problem whenever any issues happen. Models should be changed every single time. Over-reliance on a model never works out, and over-dependence on one led to the demise of LTCM.
To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense. I don't care whether the odds are 100 to 1 that you succeed or 1,000 to 1 that you succeed.